Kyle Sonlin and Herwig Konings are founding partners of Security Token Group. All opinions expressed by them or guests on this podcast are solely their opinions and do not represent the views of Security Token Group or its subsidiaries. You should not take any opinion expressed on the show as a specific inducement to make a particular investment or follow any investment strategy. This podcast is for informational purposes only.
Hello and welcome back to another episode of the Security Token Show. We're here to give you the latest and greatest security token news and information. I'm your host, Herwig Konings, joined by my co-host and business partner, Kyle Sonlin. And we've got a crazy good episode for you today. We're going to get into the hot topic of Tether. Is it a potential scam? What's going on and how does it impact the stablecoin world? But before we do, we need to, of course, go over our sponsor who makes this show possible, which in this case is thanks to the exchange. The exchange is actually launching a security token offering called TurnCoin, which is a revenue-generating security token powering the exchange NFT platform where anyone, influencers, artists, celebrities, athletes, and actors can go and create the digital collectible trading cards for themselves on the exchange called virtual stacks. Now, of course, these virtual stacks have a processing fee that gets sent to the company, which entirely, 100%, gets sent to TurnCoin holders. So go buy some TurnCoin if you're interested at turncoin.com. Meanwhile, let's get into the show, Kyle.
We're set for an amazing show. Thanks to TurnCoin and the exchange for being our sponsor. But let's kick off episode 105. The way we do this is we start off with our companies of the week. Herwig and I are going to break down the 2 companies in the space that made the biggest moves. From there, we go into our top 5 headlines. You can't miss the 5 things happening in the space, institutional or traditional, what's going on in the security token space. From there, the rest of the team is going to break down the industry news, new security token offerings, and market updates. You're going to get all of it for them. And then we're closing it out with our coverage of stablecoins, talking about Tether, talking about other ones, what that implications could mean for the industry moving forward. So without further ado, Herwig, episode 105. Who is your company of the week?
Well, Kyle, it's my pleasure to once again bring a known name to the space here, to a Company of the Week award, Coinbase. Coinbase has come out again with another major announcement that I just felt like it had to give some attention to it. They have said that they are going to take $500 million on their balance sheet and buy cryptocurrency, including Ethereum, Bitcoin, and many others. In fact, they claim to be the first publicly traded company to be doing Ethereum, Bitcoin, DeFi, staking, as well as altcoins. So that's pretty impressive, but more so because Brian Armstrong, actually the CEO of Coinbase, said that they're going to also do a 10% of all profits towards cryptocurrency acquisitions going forward. So that's a big deal. In fact, he said he even thinks that number will increase over time. But just to put it in perspective, Kyle, you were telling me the other day, they did $1.6 billion last quarter in profit. So that's no small chunk of change. In fact, if you extrapolate that, close to maybe $6 billion a year in revenue right there, that's another $600 million. We're now talking north of $1 billion that this company, Coinbase, is going to be making in purchases in the cryptocurrency space. And that's annually, probably getting even bigger as the company grows. So that's exciting stuff for the space. I think that's a huge testament and why I chose them as Company of the Week, because they're eating their own dog food, and that's why I love it. Congratulations to Coinbase.
That's fantastic. Totally makes a lot of sense. They're doing so much for the industry in terms of bringing in institutional players and providing custody for Bitcoin, which can be scary for some people. And so, yeah, eating their own dog food is huge. They also have an ATS. We've wondered if maybe one day they'll get into security tokens. As of right now, it doesn't seem like that's the plan, but maybe in the future, that's something that they explore as well. And certainly as this market continues to grow and develop, the security token industry is just so much bigger and has so much more potential, I think, than even crypto alone. So
you got to take away from this that other companies are going to follow suit. And this is something that the security token world can replicate too. So that's exciting stuff. Now, Kyle, how about you? Who did you choose for your Company of the Week?
So my Company of the Week is a company that I wanted to bring a little bit of exposure to because I think that they have a very innovative structure and a cool business plan, and that is ThinkaToken. Now, with ThinkaToken, what they're doing is they're tokenizing a cattle ranch. They're starting with the La Padera property, and they're essentially taking a 3,200 hectare cattle farm with thousands of cattle on it, and they're actually tokenizing the revenue that will produce from that live stock. And so I think that they've done a really good job of marketing. They've been driving a lot of exposure to their deal. I'm hopeful that they'll be successful in this raise because it's an interesting asset that's exotic, but one that presumably has very strong returns and that you wouldn't necessarily have exposure to in the traditional markets. I think it's a really cool use case. Wanted to give them a shout out this week.
Totally a great choice. Once again, highlighting the capability of security tokens. You can tokenize almost anything. And just as you said, it's not easy for anyone to just go get investment returns from a cattle ranch. That's a difficult thing to get access to unless it's the Finca token, apparently. So that's fantastic. Congratulations to Finca.
And with that, I think it's time to dive into our top 5.
Let's do it.
So kicking into our top 5 here, Herwig, we're starting it off with the biggest piece of news this week by far, which was that T0, the leading security token exchange, both by market cap and trading volume, and maybe the one that everyone knows the best, their CEO has stepped down. Sam Norsalihi, who has led the company now for years, has officially stepped down from his role as CEO. And Alan Konevsky, who is the chief legal officer for T0, has assumed the interim CEO role. And so Sam noted and the company noted that this was a mutual agreement. Sam has felt that he has brought the company through to its strategic vision, but he needed someone else to come in and execute. Presumably, especially now that they're bringing on a legal officer to be the CEO, there were some compliance and some other things that they really need to dive in and nail down to work through. Konevsky has come out and said that his goal is to aggressively pursue the milestones and deadlines that they've already established. So it doesn't look like they are changing directions by any means, specifically highlighting bringing on additional assets and really doing some of the things to scale the platform up. And this is a big news.
And they stuck to it, and that's definitely big news whenever a CEO steps down. Of course, you wonder, why, and of course, you want to read beyond what the company has mentioned. But it seems like Alan is absolutely sticking to his word because they shortly announced afterwards that Exodus will be going live on September 14th. So that's number 2, folks. Exodus is going live September 14th on T0. That's huge news for the industry. If it doesn't happen before then, it will break the market cap over $1 billion.
Yeah, I've got a couple quick little stats on that. Exodus has a crypto wallet. They're selling equity in their company. They raised a $75 million Reg A+, which means that anyone could invest in that, retail investors included, and they will also be able to trade anyone just like a stock. They have 2 million users on their crypto wallet. So this is not just like a startup. This is a company that's been in existence for a while, very successful, and they just raised that 75 at a $700 million market cap. So to Herwig's point, not only is it going to push us just over that billion mark, which we haven't quite hit yet, but we're going to be very close to 2 billion. So very exciting stuff. There's going to be more information on T0 as a call. I think it's on September 1st. You'll be able to tune into. They have actually invited me to ask some questions there too. You can learn more about everything going on there.
Definitely go check that one out. Now let's get into number 3 here. We've got the biggest legal case for the space of the year here. This is, of course, the XRP lawsuit with the SEC. For those of you who are not familiar, XRP was one of the biggest ICO sales in history, billions of dollars. And it took a little while for the SEC to come out and then finally say, hey, you've been violating securities laws with your XRP sales. Now, of course, the company has been aggressively fighting this. And one of the big key arguments that they are making is that the SEC did not give them fair notice about the fact that they were selling unregistered securities. And in fact, big bombshell happened when ex-commissioner of the SEC, Will Hyman, actually was at the time saying that Ethereum was not a security, and therefore he was actually subpoenaed and brought into the case here. And now, according to the notes, what we've learned is that actually the SEC didn't qualify digital assets until 2018, and in fact, the SEC didn't approach XRP until really 2020 regarding their notice about the fact that they need to come into compliance. So this definitely spells out potential good news for XRP. Of course, we have no idea where this case is going to go. But something tells me that this will eventually lead towards a settlement. In any case, I think, Kyle, it looks like a good thing for XRP.
Fascinating developments. It seems like there's new updates every week. And into number 4, we have the ex-chairman of the SEC, Jay Clayton, has joined Fireblocks. Now, we reported on Fireblocks with a monster raise. I think it was, what was their valuation?
$400 million at
A couple billion?
Yeah,
I think it was $2 billion potentially. So Fireblocks is fully capitalized. They do custody for crypto, so they're holding it and they're potentially managing and doing a bunch of other services on the crypto side for institutions and other high net worth individuals. And they have brought Jay Clayton on as an advisor. This guy clearly has a ton of experience. He's been on record saying that in the future, all stocks may become tokenized. This guy is very forward thinking when it comes to crypto, as well as security tokens and this kind of blockchain-based capital markets infrastructure. Another play. We've seen this happen before. Brian Brooks from the OCC joined Binance. He's no longer there. And but Jay Clayton.
Let's see if Jay Clayton sticks around a little longer than Brian. But indeed, we know that Fireblocks has mentioned support for security tokens in the past. So given that we do know Jay publicly is in support of security tokens, maybe that just angle might get pushed more there.
Exciting stuff.
Number 5, last but not least, BitConnect. Right? Everybody knows that little video, the crypto scam from a little while back has finally settled. Apparently 190 BTC to be paid back, as well as $3.5 million in fines settled by the promoters of BitConnect. So
it's funny how settlements work, though. They don't admit guilt. Yeah, they just pay these huge fines. So they technically haven't admitted guilt. They haven't admitted that they were a scam, but they certainly had to pay some people back.
They certainly did. And that's the top 5 things you need to know. Now let's head into the rest of the industry news.
Take it away, Jessica.
This is Jessica Burns, and I'm back for another industry update on the Security Token Show. Pay attention as we have a lot to cover, starting off with India. The SEBI mandated that starting January 1st, 2022, blockchain or DLT should be used to monitor the status of bonds or other listed debt securities. Instead of using blockchain to digitalize the debt instruments, the purpose is to monitor the assets given as security for the debenture, its credit rating, and whether or not the issuer is up to date with interest payments, and the use of blockchain applies to all non-convertible listed securities. Next, back in the US, we see that SEC announced that last week the Poloniex LLC has agreed to pay more than $10 million to settle charges for operating an unregistered online digital asset exchange in connection with its operation of trading platform that facilitated buying and selling of digital asset securities. When Poloniex sold its platform back in 2019, the sale also included digital assets being used on the trading platform that were investment contracts and therefore securities. Poloniex did not register as a national security exchange, nor did it operate pursuant to an exemption from registration at any time, so its failure to do so was a violation of Section 5 of the Exchange Act. Without admitting or denying the SEC's finding, Poloniex agreed to the entry of a cease and desist order and agreed to pay over $10 million US. Just the SEC doing business as usual at this point. Anyone is a target, clearly, given that Poloniex is on the top exchanges in the entire world. And just north of us, the Ontario Securities Commission claimed the Auxiliary Canes fintech company has failed to comply with the province's law governing securities. The OSC alleged that Auxiliary Canes may have engaged in illegal activity and could face regulatory action if it fails to cooperate with authorities. According to the OSC, the crypto asset products offered through OKEX are considered securities and derivatives and subject to the Ontario security laws. The regulator claims the company has failed to comply with the region's registration prospectus requirements. In the meantime, OKEX has issued a notice that its users cannot access its services at this time. Canada is following in the US lead here, and yes, I'm Canadian too, so expect a lot more coverage from me in that region. Moving on to the company announcements, Union Bank of the Philippines selected Hex Trust, the Hong Kong-based digital assets custodian, to test a crypto custody service with a goal to tap into the digital assets market as institutions and customer interest grows. The next stage will involve rolling out a custody service for the bank's customers. The move will allow the bank to safeguard customers' digital assets on behalf in a regulated environment. Next, Investcorp announced an exciting long-term partnership to expand the use of digital securities in an alternative investment or private market space, promising a more seamless, coordinated delivery of opportunities to investors that will benefit accredited corporate and individual investors, offering them easier access to opportunities that traditionally require high minimum ticket sizes. The Investcorp ADDX partnership could cover a variety of possible joint projects, such as private equity, real estate, credit management, absolute return investments, strategic capital, and infrastructure. Investcorp has invested almost $500 million while expanding its Asia footprint. Investcorp could potentially create more opportunities on the ADDX regulated digital security platform, which currently serves accredited investors from over 27 countries. This partnership could mean big things for the world of security tokens, and I am so here for it. The German fintech company Cashlink is taking a first step in the new regulatory environment as one of the first companies to apply BaFin to its crypto security register. This is exciting news as the law opens up exciting new opportunities, and we get excited about the fact that the legislation is driving forward the change to the DLT-based capital market 2.0, more security token players for Germany. And in Latin America, B89, a Peruvian fintech platform, is joining the growing network of node operators Polymesh. Polymesh is a permissioned blockchain purpose-built by Polymath specifically for regulated assets. It is currently in testnet phase with the mainnet launch anticipated for later this year. With B89 working as a node operator for Polymesh, there are 13 regulated capital market participants helping to secure the chain. B89 will be the first operator based in Latin America, which will help to increase the global presence of the Polymath blockchain and the borderless network it promises to expand and benefits. The blockchain continues to grow globally. In the world of crypto, we're getting a big wake-up call as the crypto world faces a lot more legal crackdowns. In the past month alone, the SEC, the CFTC, and the Treasury Department announced more than $120 million in penalties aimed at digital currency exchanges and other service providers that officials said weren't complying with federal market regulations and anti-money laundering governments. Several states have escalated their own crypto enforcement crackdowns this summer. CFTC Commissioner Dan Berkowitz recently said crypto companies believe that rules don't apply to them, so regulators are now vigorously pursuing legal action to protect customers and ensure market integrity and prevent systematic risk. Regulators in recent weeks have made clear that they are zeroing in on crypto exchanges and DeFi platforms and are committed to becoming a regulated exchange and are looking to set up new benchmarks in this area for crypto. Digital securities have been on the rise in Singapore, where the city-state has electronically dabbled in various markets, including bonds, funds, and alternatives. A growing number of players in Asia are digitalizing securities from various financial markets to take advantage of the benefits of blockchain technology, such as efficiency, programmability, and fractionalization. Singapore, in particular, has been a strong proponent in the space, and this week the Singapore Exchange-backed security digital investment platform ADDX and investment manager Investcorp tokenized a U.S. private real estate fund. An undisclosed portion of the $150 million total was raised through digital securities. In other exciting token news today, Accounting Firm More Global published a report exploring the tokenization of real estate, in which they forecast a whopping 1.4 trillion market increase over the next 5 years. The leader of the group predicts that the emerging trends of tokenization has a potential to turn into a global mega trend with the potential to lower the cost of capital, increase the pool of potential investors, as well as liquidity. With so many massive digital security deals in the negotiation stages across the globe, there's no telling where the world of security tokens could be in the next 5 years, but we can't wait to find out. Last but not least, we have two very exciting announcements. Our very own security token advisor, Peter Gaffney, continues to grow his series of Tokenize This. This week, he breaks down the tokenization fund of funds, and you can find that on our STM blog. And before I get out of here, I just want to let you know that the Digital Assets and Security Conference will be an informative and integrative industry-supported event in Austin, Texas, bringing together builders, buyers, and integrators alike to further the understanding of the intersection of digital assets and securities. Expect expert keynote speakers, alarming predictions, exciting panels, and answers to all of your burning questions centered around digital ecosystem. Vertali is honored to host this first annual conference. The conference will be held from the 21st to the 23rd. The first day will center around a life cycle of digital assets within the ecosystem. Vertalo and its partners will be the main focus. On day 2 and 3, we welcome everyone to join us as we dive deeper into the industry and have detailed discussions on things like direct listings, APIs, issuers, and more. We look forward to seeing you there. Follow Security Token Market on Twitter for more information about the event and a chance to win free tickets. That's all from now. I'll see you next week.
Welcome to our world on the blockchain. I hope all is well in the space. My name is John Pittman, otherwise known as the Token Boy. And today I'm here to introduce you to two new security token offerings that have hit the market in the last week. First, we have a US-based financial tech company named Crypto Asset Rating Incorporated. This is a company that aims to solve some key challenges in the industry and are doing so with a custom rating algorithm that evaluates crypto asset qualifications for both institutional and retail investors. The company has launched a security token using their very own tokenization asset platform, or TAP for short. TAP is a software as a service platform that offers the process of creating, issuing, managing, and converting an asset to digital securities. They're able to do this by leveraging blockchain tech to fractionalize ownership of equities, bonds, shares, and commercial or residential real estate. Issuers and private investors will have early liquidity options through the issuance and tradability of asset-backed digital securities using the platform. The security token will be backed by Class B common stock and only available to non-US investors. Payments will be accepted in Bitcoin, Ethereum, and US dollars. The CEO of the company says that they expect tokenized securities to increasingly become more mainstream as more of our clients start to embrace tokenized securities as part of the capital fundraising exercise, which we all believe will bring change to the digital economy. For our second STO of the week, one I'm extremely intrigued about comes from a company called Liddy Capital. Liddy is short for litigation because this is a Swiss litigation finance company. Litigation financing is the practice of bringing in investors to cover the cost of a lawsuit or arbitration in exchange for a portion of the profit. So for litigation financing specialists, such as Liddy Capital, they purchase litigation assets for cases they deem to have a high chance of winning. While litigation financing often requires an initial investment of $500,000 to $1 million from an investor, Liddy Capital makes it accessible for anyone with as little as $50. It does this by tokenizing shares in Liddy Capital and then paying out dividends to Liddy Capital equity token holders when a case in Liddy Capital's portfolio is won. Litigation financing has traditionally been an investment practice reserved for the hedge fund heavyweights and elite investors. They now bring this opportunity to the masses. The CEO stated that this represents a major milestone toward our goal of leveling the playing field for litigation finance. Legal claims are an extremely appealing asset class because they can be so lucrative, and we provide a means for anyone to get in on this exciting investment. That concludes our weekly STO update. Now, for those looking for additional security token content, please check out my own personal blog called Token Board Journal over at stomarket.com. Have a great rest of your week, and looking forward to joining you on the other side of the blockchain. Now, here's Keith with your market updates.
Let's move right into the secondary market trading segment. As always, all news and pricing data is sourced from stomarket.com. Right now, the security token market cap is sitting at just above 931 million, down a modest 1.4% for the week, retracing just a bit from last week's highs. After its recent raise in token listing, the INX profit-sharing token has cooled off a bit from its all-time high of 184 last week, down 4.89% to $1.75. Still up quite a bit from its initial listing price of 90 cents. The INX token has a weekly trading volume of 224,000 and is still maintaining a market cap of right around 216 million. Mount Pelerin and their MPS token is trading on Ethereum's #1 decentralized exchange Uniswap and is coming down a bit this week, with the token sitting at $6.48, down 4.28%. MPS is holding a market cap of 3.2 million with a weekly volume of 32,000. The Overstock security token is back up this week to 68.49, up about 3.7% from 66 the week prior. The token has achieved a weekly trading volume of 430,000 and is standing strong at 299 million in market cap. Considering the INX token and its steady performance since launch, Overstock may be at jeopardy of losing its #1 position as the largest security token by market cap. Another strong trading week in the tokenized stock space. Leading the pack again this week is Grayscale Bitcoin Trust shares, with a trading volume of approximately 3.5 million, down 5.4% on the week. Right behind the tokenized Grayscale shares are both AMD, which is Advanced Micro Devices, trading at 1.2 million in weekly volume, and Alibaba in third, with 1.2 million in weekly trading volume. This is all happening on FTX. The growing cryptocurrency exchange is still maintaining a strong lead over Binance for tokenized stock trading, with Binance only taking up the 10th spot for the highest traded tokenized stock, with Coinbase shares trading with a weekly volume of 628,000. It's been another fun week in the markets. Do your own research and hit me up on Twitter at KeithDLT to send me all your hot takes. Talk to you next week.
And for this episode 105 of the Security Token Show's main topic, we're going to be talking to you about stablecoins, and specifically Tether and its potential risk on the cryptocurrency industry. A bombshell article on The Verge came out specifically talking about this. And before we break it down for you, Kyle, I think maybe we best go over, of course, we've done this many times in the past, but let's give a quick explanation of what a stablecoin is.
Yeah, so we're talking about stable coins. And the idea here is that you're trying to create stable value, right? When you look at cryptocurrencies or stocks, whatever, they're volatile, right? That's not going to be used for payments because of the fact that you're using it as an investment or it changes in price all the time, right? And so especially in the crypto industry, it doesn't also make a lot of sense to take your Bitcoin or your trading things, your commodities you're buying, and then convert them back into cash, US dollars, because of the fact that it's kind of difficult to bring it from crypto industry to your bank and then bank back to crypto. So what they've come out with is really just crypto dollars. They're stable coins, which means that they have 1-to-1 US dollar peg, or it could be euro, it could be the Japanese yen, it could be whatever currency around the world. It's essentially just a tokenized version of traditional fiat currencies, which can then be used in all of the same crypto applications that we've developed and built, allowing you to transact with a stable value inside of those ecosystems.
Stable coins have really two main values, as Kyle pointed out. Instant payments is a powerful, powerful thing to be able to leverage in a financial ecosystem. And then on top of that, because it's not built on the traditional rails of the financial ecosystem, the fees are much, much, much lower. On average, you're paying around 2.9% to go ahead and use an ATM or draw out money, etc. In this case, things are happening instantly. Let me just give you an example. Kyle wants to invest in a security token. He gets a return from that security token that comes in a stable coin. He can instantly leverage that. If he wanted to, he could go ahead and redeem that stable coin, and as Kyle pointed out, go ahead and use that cash in the old system. But in order to do that, he's going to probably have to face delays. It'll take time, and there's additional fees to then leverage that money. The same time, another security token has come out into the market, and Kyle right now already started the redemption process to bring in his old cash, and now he's missing out. If he was using a stable coin and he instead had leveraged the money to come in that way, he can instantly invest it, in fact, programmatically, so that therefore there are less fees and there's no delays whatsoever. He did not have to miss out on security token because everything was built on a digital ecosystem leveraging a stablecoin.
Absolutely right. So you stay inside the ecosystem. I think that we can understand the value of that. And then with stablecoins, you have a couple different ways that value could be created, right? How do you actually peg it to 1-to-1 of a dollar or of a euro or whatever? And there's different methods that different providers will try. The traditional method that we see most frequently, and the biggest ones in the industry follow this method, which is just having essentially a bank account that owns $100 and then issues $100 of stablecoin. And so you own some dollars, and that's what you're getting for it. And so sometimes they may be trying to make investments on and things like that to make a return or to generate more. But traditionally what you'd have is essentially just a bank vault, and then they would issue new dollars that are tokenized with their stable coins. You also have potentially programmatic stable coins where someone tries to create an algorithm that can rebalance the asset based on some really kind of deeper mechanics that we're not going to get into today. But those are really the two fields, and you're really, for the most part, and really what the conversation around the topic is today, is how transparent are these stablecoin issuers getting? Because Tether is an interesting case.
That's the crux of this issue. In fact, it's specifically Tether. We know with others like Gemini, they've come out and they have full transparency in terms of, as Kyle explained, FDIC insured bank accounts that hold the cash reserve ratio 1-to-1. In the case of Tether, that's actually not true. In fact, it was investigated and found out, and we'll get back to that. But Tether, it'd be pretty challenging to achieve what they did because right now their total market cap and supply is over $60 billion. That is no small chunk of change to just be trying to hold into a bank account. And it has grown fast. In fact, supposedly there is a potential correlation between Bitcoin purchases and the use of USDT. And that's something that we can get into on another topic. But I think it's important to recognize, to your transparency perspective, that Tether is in fact not holding one-to-one. They're leveraging a combination of cash and cash equivalents, as well as treasury bills now, as well as mostly a concentration of loans and lending partners to make sure that they have access to the money in the event that a full redemption is needed, but they don't necessarily have it on hand, if that makes sense.
Yeah, they've been taking advantage of commercial paper, which is essentially short-term debt from companies around the world. And while this tends to be, not a terrible strategy, when you've got $60 billion of assets and 50 or 75% of that 60 billion is essentially being lent out, you at least would want to know what companies are getting paid that way. And in the case of a JP Morgan or one of these large banks that does, in fact, also make investments like this on behalf of the cash they have on hand, they are very transparent. They tell you exactly what the terms of the loan were, tell you exactly who it was, all the identification information so that you can look it up and see that yourself. They have to disclose that, in fact, because if they didn't, you would have no idea. And so in Tether's case, we don't even know if it's US companies. We don't know which businesses it is. They declined to answer everything. The Verge article even goes in to say they asked specifically, is this Chinese debt? And there was no answer at all. So no, there's certainly no clarity, and I think that could be a potential point of concern.
In fact, it doesn't bode well, the fact that the company itself has some murky history already. As I mentioned earlier, they have been investigated and found to cover up fraud. Been in exchange, as well as the same owners of Tether who created it also own Bitfinex, a very popular exchange. And it found out that they were actually using some of the Tether supply to cover up $850 million worth of a loss. So that's obviously not a small amount of paper there. And, that doesn't scream positive sentiment about the management team or the company, which of course has been on a path to try and change that and put out more and more information, mostly because they're also required now by law. They can no longer operate in New York, and they have to give the regulators quarterly for at least 2 years a lot of this transparency that we're looking for. Which actually, I believe I was reading, hasn't even quite come out in the way that, of course, the regulators would like. And now, to toss it all up in there's another investigation for bank fraud and potential criminal charges, which is where we get into our discussion today, really for the whole point, which is we have the largest stablecoin that is pegged to this industry that now has potentially another issue that they're going to get into with regulators, could potentially maybe have the market freak out and have a ton of redemptions or sales happen. We saw this happen with other algorithmic stable coins. For example, the Verge article points out that Mark Cuban invested into a stable coin that had a bank run, and it went down to zero, of course, as everybody freaked out and tried to get their money out of that coin. It could happen to Tether on a very large scale. And if that happens to Tether, what happens to Bitcoin? What happens to other projects that are leveraging Tether as their stable coin to create that value that's so reliant for a lot of these financial transactions? So that's where this is very, very interesting, because Tether could actually hurt the cryptocurrency industry in the potential event of a bank run, given the fact that there isn't complete transparency. So I don't know, Kyle, what do you think? Will Tether continue to hold its value despite all of these investigations? Tether continues to more or less stick around that $1 price.
Yeah, I think that it all comes down to the use of the stable coins, because we've talked about two different terms that are very different, and I think they're important to highlight. The first one is if you're going to sell your Tether, and then one is if you're going to redeem your Tether, right? You potentially, and according to the company, have the ability to redeem your Tether for $1, which means that essentially you should be able to take your Tether, go to the company, and get one actual dollar back. But that's not usually what everybody does. If you're trying to take your Tether and convert it into US dollars, you're most likely going to go to Coinbase or Gemini or one of these fiat on-ramps, and you're just going to sell your Tether to them. And they're going to sell it to somebody else who wants to buy it from them. And they're essentially going to handle that for you. They're going to give you their dollar, they're going to take your Tether, and in that case, it doesn't really matter to you whether Tether actually has the bank, the assets in reserve or not, because the function for you will always be the same.
And given your point about the fact that there's a low level of redemptions because everyone's just selling in liquid markets that they can go to, there's actually not a lot of demand for the cash being on hand, which is why they structure a lot of things differently. And the company claims to date that no one has ever been rejected a redemption. So again, this comes down to how is the industry going to, react to something like this. And I think a bigger trend, as we do see with other stable coins like USDC, which was created by Circle and Coinbase, trying to go the right way, as opposed to sort of Tether, which is, maybe we would call it a Binance approach. But we have the CBDCs, right? The central bank digital currencies. This whole thing about concerns for the markets being reliant on private money providers, if you will, leveraging stable coins, begs the question, why don't we just have a digital dollar that fixes all of this because we can trust the US, right? So that's exactly, that's why we get into all of this. So hopefully you all learned something today. I don't know if you have anything else you wanted to add, Kyle.
It's fascinating stuff. I think that there are, there's a lot of different competing stablecoins here. And I think that if this is a concern for you, like it may be for many, including the New York Attorney General, which settled with Tether earlier this year, which means that Tether can no longer do business in New York. So don't think that they're also, unsettled at this point. They cannot do business in New York because of some of these issues. If you're going to be looking long term, look at some of the other options. As you said, Gemini is fully transparent FDIC insured accounts. I think you're probably going to see more stablecoins follow that path, especially because the SEC has come out and is taking a look at stablecoins. And I think that the more that these things pick up, especially from a CBDC perspective, there's going to be more regulations coming in here. So definitely do your own research, do what you're comfortable with. But it's a fascinating saga that we will continue to report on and give you the latest updates.
If you have any questions, feedback, thoughts, reach out to us. We're available on LinkedIn or Twitter, or join our community at stomarket.com. You can get all the latest trading information, prices information, news. We've got great media and reports from our team to go check out as well. So with that, I'd say catch you next week, and happy tokenizing.
Talk to you then.